Let's continue our discussion about options trading strategies. And today we're going to talk an options strategy that is called the wheel. And I'll explain exactly what that means. But first, let's do a super quick review if you're new to options, or just as a refresher, because it always helps. So first of all, when you are trading options, you can trade calls and you can trade puts, and you can either buy options or you can sell options. When you buy a call, you have the right to buy 100 shares of a stock at the strike price. When you're selling a call, you have the obligation, not the right, the obligation to sell 100 shares of a stock at the strike price. When you buy a put, you have the right to sell 100 shares of a stock at the strike price. And when you sell a put, you have the obligation to buy 100 shares of a stock at the strike price. So if you're unfamiliar and if they say, well, oh, this is too fast, take a look at the Options 101. It will help you with the strategy here. So let's talk about the strategy, the wheel. First of all, the idea here is to get paid while you wait to buy a stock. And this is actually the Warren Buffett strategy. Warren Buffett is using this strategy that I want to show you. So the most important thing is, first of all, you need to find a stock that you want to own, right? I mean, this is what this is all about. And here for today, for this example, I thought we can take a look at SQ. So SQ, it's Square Inc. It's a technology service. It's a payment processor. And as you can see, SQ has been in a really nice uptrend. It has been trading as high as 130. And let's just say, for our example here, that you want to buy it when it retraces to a price of 100. You see it right here. So let's say you don't want to chase it. You want the stock to come back to you, and you never want to buy a stock at the high. So it's always a good idea when you're buying stocks to buy it when they're retracing. Let's say we want to buy 100 shares of SQ when they come back to 100, and we are bullish. This means we expect the stock to go up in the long run, right? So we have a longer term perspective on SQ. It doesn't matter. It could be Amazon, you could do Walmart, you could do Tesla. So let's just use this here for an example. Now, remember, as we're going back here, selling a put means that you are forced to buy 100 shares of a stock at the strike price. So in this case, we want to use 100. Let's switch to the trading platform. We're going to SQ, and we're looking at an option that is around 30 days out. So right now, the August 21 is 37 days out. So here we're looking at 100 put, and as you can see right now, we are selling the 100 strike price, because this would mean that we have to buy the shares when they drop back to 100. So we sell the 100 put with an expiration of August 21st for right now $3.20. And since options trade in 100 packs, this means that we are receiving, because we're selling it, so we are receiving $320. Again, if you would like to know more about these basics here that are super important, I have a course for you. It's called Options 101. I'll post the link in the description. So we're getting $320. Now let's take a look at this. The broker, in order to do this, he requires only $1,000 in margin. So that is not a whole lot, right? I mean, it's only a little bit because I'm trading here on a margin account. So let's just write this down. Now, of course, if you don't have a margin account, so with no margin account, it would be $10,000. So a margin account in this case makes a lot of sense. Now, let's talk about two possible scenarios. So we're selling it for $320. And so after 35 days, when this option expires, and I know technically it's 37 days, but I want to make the math a little bit easier here. So this is why I'm using 35 days. So after 35 days, it could be that the stock is above $100. If this is the case, you still do not own the stock. So your profit and loss from the stock here is a whopping zero. But since you sold the option for $350, you're making $350. So this doesn't sound a whole lot, right? I mean, $350, but keep in mind that you made this in 37 days and you only needed $1,000 in margin here. So that's pretty good. Because if you think about it, this means you made 35% in 35 days. Not bad at all, based on your margin, right? Based on your margin. And again, if you don't have a margin account, you made 3.5% in 35 days. Again, it does make sense to have a margin account here. And if this has happened and the stock is in 35 days still above 100, so you don't have the stock, you keep the money and you can do the whole darn thing again. So you would do it again and you would sell it now at a slightly different strike price. What happens if the stock goes below $100? Let's actually say that it goes down to $90. So let's say Square is plummeting all the way to $90, but you have a long-term view, right? We expect the stock in the long run to go up. But let's say it goes down here. So in this case, the profit and loss from the stock, since now you lost $10 times 100 shares, because again, so important that you understand selling a put means the obligation to buy 100 shares of a stock at the strike price. So this is where you would lose $1,000 on the stock. Profit and loss from the option, you still keep the $350. You don't have to give this back again. So this means that now your loss would be reduced to $650. But, super important. You need to understand this. This is open P&L. Only if you would sell the stock right now, then you would realize the loss. So right now you're down on the stock. And now let's see what happens. What can we do? Now that we own this stock, this is where the wheel kicks in. So this would be here the scenario for the wheel. Now that we own the stock, we start selling calls, right? Because what does it mean? We can now sell a call, and this means that we have the obligation to sell 100 shares of a stock at the strike price. And what we would do here is that we sell a call that is approximately $20 away. So we would sell a 110 call with an expiration of September 18th. So here is, let's just see right now what we would get for a call that is 30 days out and $20 above the current price. So you see here, it's right now $5.20 over $5.35. So right now for a call, we would get $5. So this means that we would receive $500 in a premium for the option. And now again, the question is, what happens here after this option expires? So the first option 35 days, then another 30 or 35 days, doesn't really matter. So let's see what happens. Let's say it goes down to $80. It keeps going down. What the heck? I mean, what is going wrong with this stock? But it can happen, right? So now on the stock, you would lose $20 times 100 shares. So this means your total loss on this stock is $1,000. But again, this is just the open P&L. You would only realize it if you actually sell it. Now, you made $500 on the option plus, remember, initially we received the $350. So plus the $350 that we received earlier, so we make $850 on the option. And again, this is where, depending on whether you have a margin account or not, this would be 85% in 70 days. But let's just assume that you do not have a margin account, that you're doing this maybe in a retirement account. So it would be 8.5% in 70 days. Not bad at all, right? So, but let's talk, what else could happen here? I mean, there's 4 possible scenarios that I want to talk about so that you know exactly what to expect. So now let's say the stock goes up to $100. So in this case, if it goes up to $100, so initially it went down, but now it goes up. So on the stock, you would not lose anything. And again, this is the open P&L because you're planning to hold the stock for a long time. So it's a whopping 0. By the way, if you're enjoying this thus far, is this helpful? If this is helpful, do me a favor and click on like really quick, because this way I know that this is helpful and that I'm going at the right pace here. So if it goes up to $100, you're not losing anything on the stock. And again, here you have the $850. So you make this. This is why I love this strategy. And this is why I want you to consider this strategy. See, the stock didn't do anything. In fact, the stock went from the current price of 120 all the way down to 90 and then came up to 100. So the stock has actually gone down, but you have been making money. How do you like that? Okay, now let's talk about the other two scenarios, because there's a possibility that the stock goes up. So let's say the stock goes up to $105. So if the stock goes to $105, what happens? You're making $5 times 100 shares. So you're making $500. And again, this would be open P&L. So let's say that it is going in the right direction, which is what we want. We want it to go higher. And so you're making $500 on the stock, open P&L, you're not sharing it yet. And here, again, you are keeping the premium that you received. You always keep the premium. I mean, you have received the premium. Nobody can take the premium away from you. This is being deposited in your account. But now let's talk about the scenario that I believe is super important. Let's say that the stock is actually going up to $120. So here is what's now super important. Keep in mind, we sold the 110 call because what we said is when the stock went down to 90, we wanted to sell the 110 call. And again, what does it mean? When you're selling a call, it means now you have the obligation to sell 100 shares of a stock at the strike price. So let's talk about this. So if it goes up to 120, it doesn't really matter because you have to sell it at $110. So you only make $1,000 and the shares are gone. You now have no more shares. Your account is shareless, if you want to call it this way. So if it goes up, now it's perfect because you made the 500 plus 350. So you made the 850 plus an additional $1,000. So, and think about it this way. The stock only went up to 120 here. So pretty much of where it is right now. So it means that the stock came down and came back up. So now the stock is up there. And what do you do right now? So this is where the wheel keeps turning. Do it again. Since now you're shareless, what do you do? First, you would sell a put, $20 below the current stock price and earn a premium. Let's see what happens here on your account. Once you get assigned, then you're selling calls. So this is why it's called the wheel, because it keeps turning and turning and turning, which I think is pretty cool. So you can sell a put again and start it all over. This is a super powerful strategy that can make you a decent return because let's think about it. So if you can make 8.5% in 70 days, so this means 8.5 divided by 7 means that you're making 0.1% times 360. This means if you can achieve this, it means that you can make 43% per year. How do you like that? Not bad, right? I mean, for me personally, I like to make at least 60%, but it's a great strategy here. So let's do a quick summary because I think it's very important that we do this here. First of all, it's a powerful strategy that can deliver 30% per year rather safely. And by safely say, hey, you can never know. It might be that the stock keeps going down, 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 down. Of course, then you have to keep doing it and your open P&L might show a larger loss and you hope that eventually it goes up, right? So secondly, it is super important that you pick the right stock. And what is the right stock? The right stock is one that goes up in the longer run, right? But you see, yes, you can do this almost forever and keep the premium and you make more money when the stock goes up. So if you enjoyed this video and if you're intrigued by this strategy and want to learn more, I'm thinking about doing a course on this, on the wheel, right? As well as covered calls and a poor man's covered call. So it's basically 3 in 1. I haven't decided yet, but if you're interested in learning more about this strategy and attending this course, then put your name on the wait list. rockwelltrading.com/blueprint is the wait list, and there's absolutely no obligation. I just want to see if you're interested in this, because if you are, then I'll send you an email when I decide to hold this course, if I'm holding the course, which I don't know yet. And if there's not enough interest, then no worries. Yeah, no harm, no foul. Anyhow, hope that you enjoyed this video. And if you did, do me a favor, click on like, make sure that you subscribe to this channel, and please share this video. I think it's pretty good stuff. If you agree that this is good stuff, share it with everybody who might find this interesting. And go on the wait list, no obligation whatsoever. I just want to see if there's interest. so that I spend the time of putting this course together, of giving you the exact rules, what stocks to look for, what criteria they have to meet. Secondly, when it does make sense to trade the wheel, what days you should enter, right? Do you enter on up days or on down days? So all of the good stuff. Okay, anyhow, and there's probably some videos popping up right now, and click on any that interests you, and I'll see you in the next video or in the class if it happens.